Listen, man. I want to talk to you for a minute, straight up. No BS. Think about the last time you were up late, scrolling on your phone. It's 2 in the morning, your brain half asleep. You see something. A new gadget, some cool sneakers, whatever. You click buy now. Little dopamine hit for a second, it feels good. But then, the next morning or a few days later you get that hollow feeling in your gut. That sting of regret. Was it worth it? Probably not. One purchase won't sink you. Not the end of the world. But it's a symptom of something bigger. The real problem is the pattern. Habit of mindless spending. Slow, quiet accumulation of bad decisions. These little leaks, tiny financial paper cuts, they add up over time. Before you know it, you're in your 30s, your 40s, wondering where the money went. Others get ahead. Not because they're smarter, but because they learned small, consistent actions build real wealth and real freedom. Not about getting rich overnight. It's about taking control. We'll break this down. The traps in your 20s and in your 30s. These years give you the most powerful weapon, time. Choices you make right now echo 10, 20, 30 years from today. No complicated jargon, no monk lifestyle. Real, practical steps, simple fixes. Build a foundation for more options, more power, less stress. This is your wake-up call. Stop sleepwalking through your finances. Face the numbers, understand the game, start making conscious choices. Goal: save you a decade of regret. Get your money working for you. Let's get into it. The first major mistake, and it's huge, is not having an emergency fund. I see this all the time. Young, healthy, got a job, things feel good, so you spend every dollar. Reality check. Life doesn't care about your plans. It will throw you a curveball. Transmission dies. Surprise medical bill. Company announces layoffs. With zero cash saved, you're vulnerable. No buffer. Reach for a card, take a high-interest loan. Now you've got a second problem: debt. It latches on and drains you through interest. A $1,500 repair can balloon into $2,500 when you're paying around 22% interest. You're in a hole, working twice as hard to get to zero. An emergency fund isn't dead money. It's insurance against chaos. It's your freedom fund. It lets you say no to a terrible job. It lets you handle a busted water heater without panic. It buys peace of mind. Action. Save your first $500. Cancel something, sell something, pick up a shift. Move it to a separate account, label it "Do Not Touch." Then $1,000. Then 3 to 6 months of basic expenses. Not for concert tickets or a new phone, true emergencies only. This changes your relationship with money and stress. Let's talk credit cards. Designed to separate you from your money. It starts innocently. A dinner here, jeans there. You plan to pay it off. End of month comes. Minimum payment only. The bank loves this. It's a treadmill. You run hard, go nowhere. The killer is interest. Often, 20% or more, and it compounds. You pay interest on interest. A $3,000 balance at 22% can take over a decade with minimums. Thousands in interest. Money set on fire. Money not invested, not saved, not building your future. Debt steals mental bandwidth, options, and freedom. Don't normalize it. Don't accept being average. Action. Pull all statements. Find the highest APR card. That's enemy number 1. Pay way more than the minimum. Even $50, $100 extra matters. Call and ask for a lower rate. Worst case, they say no. Get aggressive and get free. The most costly mistake, putting off retirement saving. Feels boring, far away. I'll start after a promotion, at 6 figures. You're squandering your greatest asset, time. Compounding works best over long periods. Start 100-month at 25 and by 65 you could have hundreds of thousands. Start at 35 with the same amount, less than half. 10 years late, massive cost. I can't afford it. You can't afford not to. Start small. Habit beats amount early. If there's a 401k match, that's free money. Not taking the full match is turning down a 100% instant return. Action. Today, log into HR or call. Start with 3%. At least enough to get the full match. Make it automatic so you barely notice. Set a yearly reminder to bump plus 1% each year. This one small setup beats almost anything else you can do for your future. Mistake 4. The lifestyle inflation trap. As your income rises, your spending creeps or sprints right with it. New apartment, fancier car, nicer restaurants, designer clothes. Income up, still paycheck to paycheck. We tie success to stuff. Pressure to keep up. The new iPhone, your friend's BMW, suddenly your reliable car feels inadequate. You work harder to maintain an image, not build wealth. Double salary, double spending, savings rate still zero. You build a gilded prison. High income with high expenses can be more fragile than low. Action. Plan future income before you get it. Make a rule. First 50% of every raise auto-saves, invests, or pays debt. Enjoy a modest upgrade now, massively upgrade security later. Be intentional instead of reactive. Another massive mistake. Not knowing where your money goes. Ask most people what they spent on food, subscriptions, random Amazon. They can't tell you. They're flying blind. You get paid, pay some bills, spend the rest, then wonder where it went. You can't fix what you don't track. The culprits are small. $5 coffee, $10 lunch, $8 subscription. On their own, harmless. Together, real money. 3 or 4 leaks drain hundreds monthly. Money that could go to debt or retirement. Avoidance is denial. Seeing the numbers gives you power. Treat your finances like a business. Action. For 30 days, track every single dollar. Use a notebook, spreadsheet, or an app. Just be diligent. At month end, categorize, be shocked, then cut one recurring waste and redirect that money to savings or debt. The next mistake is a silent killer, ignoring fees. Small dollars here, 1% there, easy to dismiss. Over a lifetime, it's tens or hundreds of thousands lost. $100K invested at 1% fee is $1,000 a year, win or lose market, versus $40 in a low-cost index fund, $960 gap yearly, compounding into a massive difference over decades. That money should be yours. Banks add monthly fees, overdrafts, ATM charges, a tax on disorganization. They count on you not reading and not shopping around. Action. This week, pull every statement. Hunt for fee lines. Check expense ratios, call to waive fees or switch to free accounts. If in high-fee funds, learn low-cost index funds and ETFs. A few hours can save a fortune. One paralyzing mistake. Not investing because it feels risky or complicated. Keeping cash feels safe. But inflation is a guaranteed risk. If inflation's 3% and your APY is near zero, you're losing buying power every year. Investing isn't gambling. Own a tiny piece of the whole economy via diversified low-cost index funds. Over the long haul, markets rise despite crashes. Time in the market beats timing the market. Action. Open a low-fee brokerage. Automate $25, $50 a month. Buy one broad market index fund or ETF. That's it. You're an investor. Automate, detach emotion. Watch the long-term trend do the work. We covered the biggest mistakes and the fixes. Don't fix everything at once. Build momentum. Pick one mistake. Write one simple action. Schedule it. Tell a friend. Start now.